Well, welcome. My name's Patrick Foulis from The Economist, and I'm joined by Axel Weber, the chairman of UBS. We're here to talk about sustainability during the pandemic and after the pandemic when it passes. This is the first in a series of digital online events we're going to be doing in the build-up to The Economist Sustainability Week, which will be another set of events between the 5th and 9th of October. We're delighted to have you all here with us. If you're on Twitter, you can make remarks and give us comments and feedback on hashtag #EconSustainability, and please contribute to that. Now, we're going to focus on a particular area of the sustainability question, which is the role of the financial system as a catalyst to decarbonize the economy, and we're delighted to have someone who is a real authority on that subject. Axel, perhaps we can start with something personal. Tell us when you first began to get seriously worried about climate change.
Look, Patrick, thanks for having me, and it's a pleasure being here. We do have various touch points in Davos over the year, and I'm somebody who grew up on the countryside, and every time you travel to the Swiss mountains, you can see day after day and year after year how the glaciers are retreating, how the environment is changing, and how it happens permanently. And so, if you live in a country like Switzerland with a gigantic, natural beauty, you do see how that is being transformed over time. I also have more insight. I can say I grew up personally with this because my brother's a maritime geologist, and he works on the German Antarctic research, and it's all about the speed at which, say, the North and the South Pole have been melting over time and what that does to the environment and to sea levels rising. So, I've grown up both in personal contacts and in my day-to-day life with exposure to environmental and global discussions around that, and it is a very serious issue.
Well, I'm going to ask the question I'm sure your brother-in-law asks sometimes. What can the financial system do to help? We see a flurry of initiatives. I think there were over 500 ESG funds, climate and governance-oriented funds launched last year. And the financial system seems to be gearing up. On the other hand, the scale of the problem seems enormous. So give us a sense of how far finance has got and how much further it needs to go.
Well, so just to talk about the size of the problem, there's a very good estimate by the World Bank and other institutions in the United Nations, which basically says in order to be comparable with the Paris Accord and with the climate increase that is embedded there, and we still will have 1.5% climate accord, even if we succeed to to deliver on the Paris Accord, it will require 90 trillion of investments in infrastructure that leads towards more sustainability and to a better environment. 90 trillion is north of the market capitalization of all domestic equity markets that have been built over more than 100 years. So not just the size, but also the speed at which we need to do this over the next 10, 20 years is formidable. And therefore, every news about a new fund being created that focuses on ESG, on sustainability, on greening the economy is good news. It's just with that alone, we will not be able to deliver on these objectives. We need global finance and mainstream finance to deliver on this almost as a second universe of finance, which needs to be built, like with my comparison with equity markets, that needs to be built in parallel. Because mixing the two universes is actually difficult because there are traditional investments. They will continue to have to be made. But then there's new investments into sustainability, and we need a glide path which we can build that one universe and actually de-emphasize the traditional.
And plenty of people will be skeptical about the motives of the financial industry. Can you give us a sense of where the incentives come from? Is it clients demanding green funds? Is it regulators breathing down the neck of investors and financial firms? Does it come from within the company as almost a moral imperative? What's the incentive behind the financial system's behavior?
I think so. First and foremost, it is all three. And any well-run financial firm should actually look internally at what exposures they have to a very much changing environment. Now, we have been doing stress tests for carbon exposures and for our own books for many years since 2014. And so there are two scenarios. And I think Mark Carney of the Bank of England and the task force that has been built by the FSB made the difference between those two scenarios very clear. And it's very clear for every bank in their own self-interest that they need to focus on this. The one scenario is one where you do nothing for a very long time and then you fall off a cliff in terms of a crisis that erupts and you make a sudden transition, which is very devastating. And we've just actually saw that pandemic risks have been known for quite some time. They have not been at the forefront of preventive and crisis prevention activity by all players involved. And now we're learning the hard way that we should have been better prepared. We will be better prepared next time, but it's notorical learning. We learn through the mistakes we made and going through a crisis. On climate, it's the same situation. The problem is known. There's too little action now, and we need to take much bolder action down the road. And hopefully, this is not triggered by a climate crisis, because that would be the worst case to deal with this. My falling off the cliff example. The other one is where you act early, where you facilitate in a glide path a transition to a more sustainable economy, and where you can avoid a crisis or a deep challenge in the economy. And we've taken the view that we want to adjust our own balance sheet to be less exposed to climate risk, because they will come and they will materialize. So we have reduced now to 0.8% our overall balance sheet and own investment exposures to climate risks, from 3.8% some years ago to 1.9% last year, 0.8% now. The distance to go to zero isn't all that far.
You mean energy firms, assets that might be exposed to rising sea levels and so on?
Any investments, anything that under a stress scenario where a climate risk materializes would be less valuable than it is in our books now. And so whether it is lending to corporates that are involved in in activities that have a carbon impact, whether it is our own investments into projects that have carbon impact, all of these has been massively reduced, and we're not that far from phasing some of those out of our own portfolios. But we're the largest wealth manager globally. So we do the same, not just for our own exposures, but also for clients' exposures. We have an obligation as an advisor and a fiduciary responsibility to make sure that what we try and prevent in our own portfolio doesn't materialize in clients' portfolios. And there's clearly the demand from clients for their portfolios to be less exposed to carbon risks. And finally, you mentioned the regulators. Absolutely, they're on it. There is a task force in the FSB that focuses on disclosures around climate risk. And there's a whole central bank and regulatory network that focuses on one issue only, and that is using the financial system for greening of the economy. We're a catalyst in putting money where it's needed. And if we put more money into green projects, that will help this transformation. And the regulators have recognized that. And they're starting to apply pressure, soft pressure at this point, on banks to move in this direction. We don't need pressure. We've started moving years ago.
When you go and see clients, often wealthy individuals who are asking UBS to put money to work and invest, what do they say about climate change, and how have their attitudes changed over the years?
Their attitude changes actually with the composition of the clients, you see. Very interestingly, on the institutional side, most of these clients, whether it's US funds or European funds, because they invest on behalf of pension funds, they invest on behalf of companies, all of these pension funds and companies now want a more sustainable footprint in their portfolio. So there's an institutional pressure from ultimate investors to move in that direction. And many of the large asset managers have put that pressure, whether it's BlackRock, Fidelity, Wellington, or us, through their asset management divisions, are applying pressures on funds to move to greener investment portfolios. On the wealth management side, it used to be 10, 20 years ago, you saw the principal in the family that was managing the money. Now you see the family, you see the wife, you see the millennials, you see the next generation. And when they inherit portfolios, they ask the question on how comparable the portfolio is with a reasonable carbon footprint consistent with the Paris Accord. So even on the private side of portfolios, the clients are changing. Their demand for greener product is changing with the younger generations playing more of a role. And that is changing the offering that we do on the product side to these families in order to translate their investment preferences into actual portfolios that have the desired features of being more carbon neutral, facilitating such a glide path. So it's clearly there, both from the institutional and from the private side of our clients. And in the corporate world, it's the same. We have corporates that come to us and, like we have just renovated our major headquarter. We now have one of the most sustainable buildings we can move to, because when you make such investments, you always ask as well, the bank that gives you the credit, what can I do to move to more sustainability? So, we are actually a facilitator in many areas of such transitions. And that's why I think we need to put our full weight and our mind to this.
It seems a key fact, really, that ultimately your customers are demanding this, not just governments, regulators, and activists, but the customers, which provides presumably the strongest incentive of all, really.
Well, if customers drive it, that's what really unleashes the competition and the fantasy within each organization to be better and ahead of the game. If it's just the regulator, it's a bit like if it were just the regulator. My comparison always, that's like the broom car in a marathon. It takes out those that travel at the lowest speed and would continue to block traffic even after the winners have been through the finishing line for an hour or two. So you do need regulation in order to make sure that nobody stays behind and that we're actually all on a transition path, but that determines the speed of the lower travel. What really determines the speed of innovation here is if clients demand it and if firms put their mind to it in order to deliver on clients' demand. Absolutely.
So you're sitting at the top of a huge financial organization. How do you monitor the bank's climate footprint and what's happening within it? I mean, all managers, chairmen have a dashboard of metrics, reporting lines. Can you talk a bit about how you've implemented this as one of the leaders of a big organization?
So we have a committee in the bank that is a global environmental and social risk committee, which is a management committee. And management is driving this development for years, as I said, partly through stress tests and not wanting to be exposed to these stresses, and partly also because we get the demand from our clients. At the level of the board, which is the supervising part and the ultimate authority for many decisions in the bank, we have a committee called the CCRC, the Corporate Responsibility Committee, which also looks into climate change and looks into ESG issues in general. I, as a chairman, chair that committee, and we have regular interactions with all the other committees, be it asset management, wealth management, be it our corporate business in our retail and corporate world. All of these businesses are demanded by the group to go in this direction. We have a group appetite, a risk appetite for environmental risks we want to take, and we have a strategy in which we basically nail down every year the direction we want to go. And then once you develop the strategy, once you got the metric, once you got the committees in place, it's all about the implementation of this strategy and keeping the ambition. I tell you what was the biggest motivation for us. We started early. We have in Davos, every year before Davos starts, we launch another white paper on how we see ourselves and the environmental engagement we take change. So we've done that for 5 years. The most rewarding and motivating part was when you look at an index which rates sustainability, the Dow Jones Sustainability Index. We've been the leader in the banking industry 5 years in a row now. And so having been number one in 5 years ago, we put out a very simple demand. Keep us up there, whatever happens. And so we increasingly, because we have been ahead early, we need to move faster and faster, invest more, because all other banks are innovating and focusing on that as well. And that is where you put the competition between banks at work. And this is a rating that doesn't rate the Dow Jones performance in terms of financials. it rates companies in the Dow Jones according to their environmental footprint and their ESG achievements. And that is a new way of looking at things. It also relates to the disclosures that the Task Force for Disclosures of the FSB is putting out there. If we all disclose what we do in this space, if it becomes comparable, only then we give investors a real choice to invest in company A or B, dependent on what they do and what they disclose about their environmental strategy. And I think among the banks, we've been very committed to do that for years. The second part to your answer is we also engage in industry organizations. Like I'm also chairman of the IIF, and we have a task force within the IIF which is led by Standard Chartered and by some of our CEOs. All CEOs of major global firms or chairmen are members of the IIF. So the industry together is driving this, not just financial institutions themselves. It's a coalition of the willing, but I think the coalition of the willing today will be the industry leaders in sustainable investment tomorrow. And that's where I think the big incentives are for everyone joining this.
Do you think you'll ever get to a point where the pay of people inside financial firms is set based on, in part, targets about the carbon footprint of what they're doing?
I think it is already in part for what we look at in a bigger picture. It's now a small fraction of when we look at performance. But if you're in some of these areas where environmental footprint matters, then that becomes part of your objectives at which we look when we determine investment. But look, in financial markets, it's all about return. If we do not compromise on returns, which I think is a key element of where we need to go, if we actually have green investments pay off better in a medium to long term, because every materialization of an environmental risk has a cost in terms of reducing profitability in traditional investments that don't have an ESG component. In that sense, if you look for longer term returns, 5, 10 years out, green funds will perform better than traditional funds because they'll have less environmental risk materialize in their portfolio. Short term, we shouldn't forgo returns either. It's not having returns or investing in sustainability. It's investing in sustainability and having a better medium-term return as a result of this. It shouldn't be a byproduct. It shouldn't be a compromise. It should be one enforcing the other. And if that is the case, you can pay investors and fund managers better because they have a better medium-term performance. So ultimately, I believe if we do work with the incentive structures of the financial system, we're much better equipped to make a transition than if we see the financial system as not as a facilitator. Actually, whatever we need to do, the 90 trillion number is so large that we have no chance to build this without motivating major financial institutions to put all their financial knowledge and engineering power behind this and make it a large-scale standard financial market. It will be a different market. It will focus on sustainability. It will focus much more on medium-term returns comparable with good environmental developments. But that's the right thing to do, because if we don't, we are on this first glide path I talked about, where you do nothing for a long time and then you fall off a cliff. It's much better to transition over a slower path, but to make sure that you do transition.
So I wanted to turn to perhaps some of the potential problems with the financial system's interaction with climate change. And one that strikes me as particularly relevant is the idea that dirty activity migrates out of the largely Western banks, largely European ones really, who are most climate focused, and migrates into other areas of the global financial system in a rather unsatisfactory way. And in fact, I think there's been some analysis by your own analysts at UBS, which shows how a lot of the coal-fired power generation in Asia now, which is a big source of future emissions growth, is financed by either Asian banks or particularly state-run banks. So is there a kind of whack-a-mole effect here where UBS cleans up its loan books offers green products, but people who want to build coal mines or power stations just shift to another part of the financial system that isn't as climate conscious?
That's always a risk. And look, I've been a central bank governor in the last financial crisis in 2008, 2009. One of the problems that happened was as we re-regulated the industry, and we at UBS have been very early on basically supporting the re-regulation because we felt it was the right thing to do. Better capital standards, better liquidity management, all of these things. And the core of the financial system, the large global systemic banks, have really transformed and are now much more stable. This is why they all have withstood the current pandemic crisis, quite well on impact. But it still means that the parts of the financial system that weren't regulated as much, shadow banks, as they're frequently called, have been taken over activity formerly done by core banks, and that has migrated into the shadow banks. I don't like that name because they're actually not banks. I call it market-based finance. And the major challenge you get in this area, as well as the one you highlighted for environmental concerns, is that regulators need to make sure that there is a level playing field. If you overly focus on regulating heavily regulated industries further, but you apply no regulation to adjacent activities, it is pretty clear that those that want to avoid the regulation, those that want to avoid the transitions, will migrate that activity into less regulated areas. It's a well-known phenomenon from taxation policy, where basically taxation in parts of an economy leads to the avoidance and the migration of taxation to adjacent activity. That's a regulatory challenge. That's not, in my view, a challenge or an obligation of the industry like the banks, where I take responsibility now. It's not an argument against the transition we need to do. It's an argument for the regulators to make sure that as that transition happens, and it needs to happen, that they ensure a level playing field, that unregulated entities don't evolve and take over activity that we actually wanted to phase out in the core of the system, and that they don't become peripheral activities, but actually could grow in the shadow of regulation without sort of clear supervision to a level that is dangerous to the economy and to society at whole. So it's a well-known phenomenon. You're absolutely right. It's a risk that this might happen, but it's a risk that needs to be addressed by regulators and also clients. I think if you are looking into the transition that we plan for carbon, you will see that even in the year 2030 and beyond, even 2050 in the Paris Accord, carbon forms of energy still play a important part, if not a dominant part, in that transition. It's just if we don't do anything, they'll remain at 100%. If we do things and push them over the next 30, 40 years to a 50% share, then at least we are on that transition path. So it's not, per se against having other forms of energy, because largely where we are on the energy mix, which is the key driver of this transition to carbon, really depends on initial conditions. Industrial countries can do much better than some emerging markets in facilitating this transition because we have a much more general energy mix and are much less reliant on primary energy sources like coal or oil. A country like Switzerland, where we have a lot of mountains and energy based on water turbines, we can make 100% electricity transition, which we will do by the end of this year, 100% renewable electricity, because most electricity is won through renewable sources rather than other forms of energy, electricity. So I think in general, the transition depends on the starting conditions, but everyone needs to be on a glide path. And that's where I think it is up to us all to really avoid that too many of the regulation stays behind. And for this shadow industry that is emerging, that's where my example of the broom car in a marathon is relevant. You need to, as a regulator, phase that out and move everyone along on a journey. And those that haven't moved, you actually need to, really need to impose heavy taxes and heavy carbon taxes on activities that haven't been transformed, despite the fact that maybe there is technology that you can use to transform it to less carbon emissions. And so there has to be a regulatory element and a level playing field and sort of heavy-handed regulation for those that don't move, but more facilitating regulation for those that move.
Second problem with climate finance, and perhaps Axel, you could just talk to this briefly. It's something a lot of people worry about. The quality of measurement seems terrible. We have ESG ratings which contradict each other. It's hard to really work out what the true carbon footprint of a loan book or a portfolio of shares actually is. How big a problem is that, and how optimistic are you that it might be sorted out?
Well, first, I think the disclosure standards that I mentioned by the FSB are important standards because there everyone starts disclosing along the same standard. It's a bit like the accounting standards or banking supervisory standards. Once all firms start disclosing along these standards, and we are supporting that, and we have adapted our own reporting in that line and in that direction, as everyone reports around that, these indices become more reliable because you disclose more standardized information in a standardized way. And like accountants can sort of create comparable books when it's financial disclosures, your carbon disclosures and your ESG disclosures will have to be standardized in measures. Now, the problem we have is we ended up in the accounting world when it comes to financial with two standards. A US standard and a European standard, and we all hoped it would sometime converge to a single standard. It hasn't. And my prediction is it won't. In carbon standards, we should not accept that. We should really, because it's a global phenomenon, ask for a single global standard. And the fact that the FSB and the Task Force for Climate-Related Disclosures has developed such a standard gives me good hope, since there are no two legacy systems that we need to overcome, that we can develop a single disclosure standard for these at the global level. The second thing we need to do is, in my view, we need to bring in a lot more pricing issues. That is, if you look at how at the moment, disclosures is one area, but the other one is actually what do you pay if you create pollution? And that's where a single price for carbon globally is going to be very important. If we were to have such a single price for carbon, like benchmark rates in financial markets, all activities could be around that level. And when it comes to disclosures, people often say, so is that a good company or is it a bad company when it comes to environmental standards? And that's hard to do if you look at disclosure standards. But if it's being priced by specialists, one good question to ask is, where is this company trading? What is where do they trade at a price that is consistent with the transition to a carbon, to the Paris Accord by the year 2050? Because that would be the relevant price for pricing carbon right. If you trade above, it means your corporate strategy is not consistent with you fulfilling that standard by the time you get there. If you're ahead on that path, you might actually trade at a price that is lower. And so I think ultimately we need to bring more markets and more market-related pricing to the carbon transition, because that would facilitate everyone being judged against a benchmark price, and that price would be the carbon price, the price for 1 ton of CO2 emissions to be out there. And then companies can align their own carbon reduction strategies and net carbon zero strategies around the glide path of that price. And that price, of course, like the oil price or the energy price, will move with time. But it's going to be very important that you get a price signal as well as disclosure around your strategy, because basically I look at these prices as a single number that sums up the entire history of what the company does, what it discloses, and how well it does in a single price. Where does it trade? And I think that's the rigor that we have from equity markets, where basically the share price reflects the value of the company in almost all dimensions, basically embodied in a single number. And I think if we develop such a similar single number reflection on where somebody trades relative to the carbon price, that would be a very good way to actually sum all of this up in a single meaningful number. And that's where we need to facilitate markets. We need to facilitate the infrastructure of such a market. I myself am skeptical that you can mix traditional finance with green finance. I'm pretty sure that we will need to develop, because it's a different metric and a different goal we want to achieve. It's not short-term annual or quarterly profits. It's long-term sustainable performance. And so I'm pretty sure that we need to develop a second type of metric out there, a sort of ESG market that around greening the economy, and green financial markets will have different objectives and it will have different metrics around performance than standard markets who basically are on quarterly reporting. And mixing the two creates a lot of questions, as you said, that people look at these ratings and say, so what does this actually tell us? I think we need separate ESG ratings and they need to be tied to a price. And if companies do well or bad, it needs to be reflected if their price. If a company, discloses something that is not good because they're forced to make an ad hoc announcement that some of the previous disclosures are wrong, this will get massively priced in such a market immediately. Ratings are much less sensitive to that. So I think we also need, when we want financial markets to play a role, we need to accept that pricing and listing and trading of such activities will have to be part of the game.
So what you're talking about here, Axel, is that the introduction or the stepping up of carbon taxes and proper pricing of carbon in turn catalyzes a whole new universe of green finance that's far bigger,
Absolutely.
far more sophisticated than the one we see even today.
I'll give you an example of the World Bank again. The World Bank has estimated that at the moment, out of, there is already trading of emission rights, and there are already carbon trading system based on carbon prices, but they're fragmented, they're, in different countries, but there is a market. And when you look at that market, 80% of that market trades at prices that have nothing to do with the Paris Accord and the journey we're on in order to reduce greenhouse emissions and to reduce global warming. Only 20% of carbon pricing is related to that. And out of that, only 5% of those carbon prices trade at a level that is consistent with the Paris Accord. 5%. The rest trades at carbon prices that are way too low to be consistent with the Paris Accord. And we know how markets work. If you make the carbon price where it trades way below that consistent price with the Paris Accord, if they're too low, you need to raise them. And when you raise these carbon prices, in more than 95% of the markets don't trade at the appropriate price for that, of course, you will get a greenhouse emission reduction simply by increasing the price of those emissions immediately. And the other problem we face is, like in financial markets, not everyone will support that initially, and not everyone will be part of it initially. There, you need, of course, different markets need to be reflected in cross-border adjustment taxes. If you have a carbon price or a carbon tax, and the carbon tax is way too low in some countries, you need a border adjustment tax when those countries trade with other countries where carbon is priced rightly into the tax system and into the emission systems. And that needs to be an extra levy that is on goods that are supported by being produced in low environmental standard countries. That's what we have already today. When you look at interest rates in financial markets, if interest rates are different between countries, it's usually the exchange rate, the cross-border price, that puts both at a level footing. And the same is true with taxes. If you have taxes in one country being different, import duties basically eliminate some of the tax differences that are otherwise there. The same needs to happen for carbon prices. If the carbon price is too low, you need to have a price add-on if products cross the border from a low price to a high price country, in order to protect the industry in the high price country that does the right thing and actually prices carbon at the right price. So I think we need to move to a global system. It will be a journey of a few willing, but they also need some reassurances and some safety valves involved so that there isn't any arbitrage developing globally about pricing carbon right and transforming your economy and not doing that and actually gaining benefits by doing the same activity at a lower cost or at a lower tax level. So I think you need to put a lot of institutional work in place. The financial markets can go ahead and create the investment opportunities, But when it comes then to product creation, when it comes to trading based on these on such markets, there's a lot more work that needs to be done. And for me, the task is as formidable as it is when you build financial markets globally or you build goods markets globally. This is a market for carbon that needs to be created globally, and it will have implications for both financial markets and goods and services and prices of goods and services, as well. So it does need a global coordination. It's a formidable task, but if we don't start today, and we're already behind the curve, we will be as little prepared for a global crisis around climate as we were prepared for actually a known risk that was out there, which is the pandemic risk. The risk around climate is as known as the pandemic risk was. Let's not go through a crisis in order to prepare for a better environment in the future. And let's take the lessons from the COVID crisis that we were not prepared as a real incentive to not face the same fate in the future when it comes to climate, that we again face another crisis and we're not prepared and we learned the hard way.
Well, thank you, Axel Weber, for giving us what is a really expansive vision of the future role of a green financial system in combination with carbon taxes and what it can do to potentially combat climate change. And it's also great to hear a bit about what UBS is doing specifically to stay ahead of the pack. For all of you listening, and thank you for tuning in, just to remind you, this is the first in a series of virtual events we're going to be doing in the build-up to the Economist Sustainability Week, which starts on the 5th of October. And I do hope you'll join us for more of these events and keep track of what's going on. Also, pleased to encourage you, if you've got things to say, if you've got feedback, if you've got views, do go to Twitter, hashtag #EconSustainability, and tell us and other people what you think. Axel Weber, thank you again for joining us.
Patrick, thank you for having me, and good luck with the series. It's really a great idea.